Okay, in the History of Banking video, we learned how and why banks came to be. We also learned that some of them experimented with abandoning the 100% fractional reserve banking model. What is 100% fractional reserve banking? Let's think about this a bit more carefully. Banks have assets and liabilities, fancy terms for things they own and things that they owe. Things that they owe are mostly composed of deposits, the money people deposit with them. The things they own are what they use those deposits for. They can issue loans to people or buy other assets that pay them an interest rate, whatever. But they do have to use that money that you give them somehow, otherwise they'd just be warehouses full of cash, just sitting around. So banks find ways of using the money you give them in productive ways. Once they loan that money out, they earn their keep by paying you, the depositor, less than what they earn by loaning that money out, a lot less. This is the traditional view of banking. There are competing views, but we'll get there hopefully. So now what's the problem? Well, if the bank has given your money to someone else, that money is no longer with the bank and won't get paid anytime soon. Most loans have a long repayment period. Think of a mortgage. This is called maturity transformation. They take what appear to be short-term loans, your deposits, and transform them into long-term loans, mortgages. Sure, they keep some of that money around so that you can use it for transactions, but if you, me and Putin were to go to the bank to withdraw all of our money, they couldn't just give it to us because it ain't there. This is where 100% fractional reserve banking comes in. Some of the early banks just kept all of the money they owed around in the form of gold or silver. So if you wanted to convert your notes into gold, they had it. So how did they make money? Mostly fees and their own investments. Want to hold your money with us? Pay us. Want to pay your donkey dealer? Pay us. But this wasn't really a good money maker for them. So when they issued paper currency on the back of the gold or silver they held, some got carried away and just issued more paper than they had gold, as in the case of Stockholm's Banco. Apparently people are weird about their money, and once you start issuing notes willy-nilly, they get queasy and want their money back. In the early days, this happened a lot. For example, the 1893 panic in the US. What happened? During the late 19th century, railroads were the backbone of the US economy, and speculative investments led to overexpansion. By 1893, many railroad companies were heavily indebted, mostly to banks, and unable to generate sufficient revenue to meet their obligations. They just couldn't pay the banks. The bankruptcy of the Philadelphia and Reading Railroad in February 1893 was a critical trigger. Falling crop prices and poor harvests also left farmers struggling to repay loans, leading to defaults and stress on rural banks. Farmers, a significant part of the economy, were also hit by high transportation costs from the over-leveraged railroads. All of the above basically tells us that the banks had made some large loans to a couple of sectors, and once those sectors couldn't make money, those loans went bad, and the bank had a lot less assets than it had liabilities, a fancy name for other people's money. People, and by people we mean economists, call this insolvency. How did the crisis unfold? In May 1893, banks across the US began to fail. Due to insolvency and a lack of liquidity, thousands of banks closed, especially those in rural areas tied to agriculture and railroads. The New York Stock Exchange experienced a severe downturn, with stock prices plummeting, particularly in railroad and industrial shares. Industrial production dropped sharply, and factories across the nation shut down. The unemployment rate surged to nearly 18%, with millions of Americans out of work. As this case teaches us, once people see that you are really far off from covering your deposits with your assets, they get twitchy and start running away from you by pulling their money out. Alright, so how do we solve this? Seems like a big deal, right? We should find some sort of solution to this mess. One solution people proposed was to have the government guarantee deposits. The argument here is pretty clever, and it eventually won some economists a Nobel Prize. How does it work? Well, I panic about my money at the bank mostly because everyone else is panicking about their money at the bank. Panic is kind of like a disease. We catch it from each other. Once enough people start panicking, everyone starts panicking too. So how do you stop the first people from panicking? You just tell them that whatever happens, their money is covered by the government, so no need to panic. So if no one panics in the first place, the disease does not spread, and we're all happy campers. And this is called deposit insurance. Sounds good, right? Well, not so fast. First, you would have to trust that the government would actually come through with that promise. So if you're living in a poor country, that doesn't really convince you. On the other hand, deposits are so large that any government telling you, "Don't worry, you're covered," is a bit suspicious. So what do governments do in this case? They put a cap on the amount that is guaranteed. This varies across countries. Currently in the US, it is $200,000 to $50,000. There is another option, just closing the bank doors and stopping all the checks, so people just can't run on the bank. This is called suspension of convertibility, which sounds like not so much of a big deal, but it is. Basically, this is a let's hope they forget about this tomorrow kind of solution, but it really isn't much of a solution at all. Argentina tried it when they had their bank run in the early 2000s and ended up with broken windows on top of a bank run. Interestingly enough, on March 6, 1933, President Franklin D. Roosevelt declared a national bank holiday, temporarily shutting down all banks to prevent runs and stabilize the banking system. So the holiday wasn't really meant for us to just hang out. So do these methods work in preventing bank runs? Kind of, but not always. There were a couple of recent bank runs that made it obvious that it's not that simple. Silicon Valley Bank and First Republic Bank failed in 2023. Let's look at the failure of SVB in a bit more detail. Silicon Valley Bank, or SVB, specialized in banking for startups, venture capitalists, and tech companies. It experienced rapid deposit growth during the tech boom of the pandemic years. Deposits nearly tripled between 2020 and 2022, reaching about $209 billion by the end of 2022. So what was the problem? SVB invested much of its deposit base in long-term treasury bonds and mortgage-backed securities. Rising interest rates by the Federal Reserve to combat inflation sharply reduced the market value of these bonds, since the higher the interest rate of the bond, the lower the price it is sold for. Meanwhile, its largely startup-focused customer base began withdrawing deposits due to a slowdown in funding and higher cash burn rates. And this caused the usual insolvency issue that we mentioned earlier. Assets, things you own like loans you make to others such as the government, are much lower than liabilities, which is what you owe to people. This is what is called an asset mismatch. By late 2022, SVB's unrealized losses on securities exceeded $15 billion. These losses were not a problem unless they needed to sell the bonds. Unrealized losses are losses that occur when the stuff that you have falls in value, even though you haven't sold it yet. So what triggered the bank run? On March 8th, 2023, SVB announced that it had sold $21 billion of its bond portfolio at a $1.8 billion loss to meet liquidity needs, and that it would raise $2.25 billion in new equity to shore up its balance sheet. This spooked investors and depositors, prompting a bank run. Depositors attempted to withdraw $42 billion in a single day on March 9th, 2023, the largest bank run in US history. SVB could not meet withdrawal demands and was shut down by regulators on March 10th, 2023. In the aftermath, the FDIC took control of SVB and guaranteed deposits to prevent contagion. This action protected depositors but did not fully shield equity investors or unsecured creditors. SVB's failure sparked fears of instability in the banking sector. It was followed by the failure of Signature Bank and stress on regional banks like First Republic banks. So why didn't it work in this case? Well, A lot of the people that were putting their money in SVB were big shots with lots of money and startups that were putting all of the money that investors were betting on them into SVB. This means that a lot of the depositors were above the $250,000 deposit guarantee, so they knew they weren't covered. So they panicked and ran on the bank. The government eventually said that they would cover 100% of the deposits, even those above the limit, because they were afraid that customers at other banks would panic too and start a run on all the banks, and that would be kind of bad. In the end, they helped the sale of SVB to another bank and closed that chapter without much more damage, but we're sure some people were sweating bricks for a few days. So bank runs can still happen, and they often do. They seem to happen less frequently, and good central banking and government oversight may have something to do with this, although people will disagree. But if we think about the facts about what happened at SVB for a second, you will find a bit of a flaw in all this. The bank is supposed to be careful with what they use your money for, because if they become insolvent, meaning what they are owed is much less than what they owe you, people will get nervous and run on the bank. But if the government is putting some sort of guarantee that calms us down and stops the panic, wouldn't that basically remove the incentive of the bank to be careful with your money? If every time they are stupid with your money and the costs to them are low because the government puts a guarantee, doesn't that mean they'll always be stupid with your money? Economists call this kind of problem moral hazard. They have weird naming conventions, but the idea is simple. If when you fail you are protected from the costs of failing, then you do things without taking into account the costs of failing because you don't care. A solution to this has been to force banks to hold a certain level of capital by law. These come as regulations called Basel I, II, III, and IV, named after a place in Switzerland. I mean, where else, right? So banks are basically forced to hold some level of assets, hoping this will make them solvent in crisis. How do regulators make sure they are solvent? They periodically force banks to do stress tests, which are basically scenarios where things go bad, and the banks are supposed to forecast how their balance sheets would respond if things went bad. So regulators ask the bank, tell me how your assets would perform if the economy shrinks by 2%. Give me a detailed answer. This is a very difficult problem to solve and depends on a bunch of very complicated predictions, and as expected, does not always work. There is another thing that complicates our problem. Some of the people taking money and investing or loaning it out are not even banks in the traditional sense. So a lot of this money is sloshing around in another part of the economy, which people have called shadow banking. In fact, the 2008 Great Financial Crisis was mostly due to shadow banks. In another video, we will explain what these ominously named things are and why they are important. So that's where we are, in a world where governments and central banks want to make the system stable and prevent bank runs, but when they try to do this, they kind of give banks incentives to behave badly and take too many risks, because when those risks materialize, banks won't get run on due to deposit insurance. Sure, the banks pay for the privilege to the FDIC, the Federal Deposit Insurance Corporation, which deals with these matters, and so it's not entirely free, but the gains from not having to worry about runs are so large and the moral hazard problem so big that the current state of affairs doesn't seem satisfactory. It's a difficult problem to address, and there are plenty of people trying to come up with solutions. Some, like John Cochrane at Hoover, have suggested 100% fractional reserve banking, and if people want to deposit with other institutions that do not have 100% fractional reserve banking, they take their own risks. If we get enough follower requests, we may even get into that discussion.